Hello. Today I'm going to talk about topic 5 practice questions. So first I'm going to review the key point on topic 5 and then try to solve each questions. So first of all, why we study international asset pricing model? We want to know how to calculate the expected returns. One source would be risk premium. Then we need to know what is the risk here, the systematic risk. For that, we need an asset pricing model. And also we use this as a pricing model to think about several practical questions. So we're gonna talk about this case in practice questions. We first talk about the domestic asset pricing model, start with the CAPM. So excess return on any risky asset J is equal to beta of that asset times market excess returns. How do we know whether this model is a good model or not? In order to test that, the test the CAPM, we can run our regressions using historical data. So we have the historical data of the excess return for SHA, and we run these regressions. So we have something like this, linear functions. So our excess return is YT, is explained by intercept plus slope times some variable, which is market excess returns. Since sometimes this relationship doesn't hold exactly, we're gonna add error term there. So sometimes this number and this number will be different by epsilon t, but our assumption on the regression is, on average, this difference is equal to 0. So that's our assumptions when we estimate this model. And then using regressions, using ordinary least squares, for example, we can estimate the intercept and slope. Because the intercept is called alpha of J asset, the slope is called beta of J asset. Now, if you take expectations on both sides, which means you want to compute average value of the left-hand side and right-hand side. So if you compute average value, this is the average excess return from investing into SHA is equal to alpha plus slope times average market excess returns. Now, if you move alpha j into the left-hand side, we can interpret alpha j as the average return from investing into J, the historical returns, minus RF minus beta J, ERM minus RFT. Now we interpret this term here as what CAPM says this asset should earn, right? So what we have here, alpha, means the average return to invest into SHA. If this is bigger than 0, that means the average excess return is bigger than what CAPM says you should earn. So alpha is positive means investing into this asset gives you extra returns. So we can test whether alpha j is equal to 0 or not. If alpha j is not equal to 0, we're going to say we have an anomaly, return anomaly in terms of CAPM. Now, two famous anomalies, size anomaly and value anomaly. So what is a size anomaly? If you invest into a group of small firms, the small firm stock tended to have higher holding period returns, even after accounting the CAPM beta risk. So this part is important. This is not about earning positive return from investing into small firms. It's about the alpha. What you earn from investing into small firm, it's much bigger than what CAPM says you should earn, right? So we always say alpha in terms of this. So CAPM alpha, we use CAPM to compute what should earn, right? So alpha of small firm is bigger than 0. That's a size anomaly. How do we actually implement that? One way of implementing this strategy is using size anomaly is zero cost SMB strategy, small minus big strategy. So what we are going to do is to buy a portfolio of small firms, but you finance it by short selling a portfolio of large firms. So what is going to be the return from this strategy? ER small minus ER B. So R is holding period returns. And in the lecture, I explained why this is the return for short selling B, right? Anyway, we use this symbol for this. So when you see ESMB, it just means the return from implementing this strategy, ELS minus ELB. If you have any question, you can ask question using chat window. And what is a value anomaly? When you invest into a group of value firms, you tend to have higher returns even after accounting for the kappa and beta risk. So again, this is about alpha, not about just getting positive returns from investing into value firms. You get extra returns. You get more than what CAPM says you should earn. How do we implement? So you're gonna buy a portfolio value firm high, but you're gonna finance it by selling a portfolio of group growth firm L. So high minus low. That we use these expressions as the expected returns for investing into this value strategy, zero cost HML strategy. Now, based on these two anomalies, Smart French provide this APT type model. So again, the left-hand side, we have average excess return from investing into SJ, and we have CAPM factor. So this is CAPM term, and two additional terms from these two anomaly. So we have three sensitivity. And how do we test for French three-factor model? That's before we're gonna run the regressions. So now in our regressions, we have two additional factors, SMB, HML. Previously, we didn't have these two factors, and we run these regressions. So this regression looks like EX1, P1X1 plus P2X2 plus P3X3. So linear YT, left-hand side variable, excess return is a linear function of right-hand side variable, but this cannot be true all the time. So we allow epsilon t error terms, right? And we assume this thing. That could be positive error or negative error each point in time, but on average, the error term is going to be 0, right? So that's the French three-factor model regressions. And then using least squares, OLS, we're gonna estimate alpha, beta, SH. So you got the number, and then let's take out expectations on these regressions. As before, what is the meaning of this one? This is the average excess return from investing into SJ, historical value. What we have here is the historical value of market excess return, historical mean of the investing into SMB, historical mean of investing into HML, and we know what is alpha, beta, SH from the regressions. We know all the number. Now, if you move alpha j into the left-hand side, we can express alpha j is equal to what you earn average by investing into SJ minus what this means the return you should get if you think Pharma French is a good model. So Pharma French says you should earn this excess return by investing into SJ. So what you have here, what is the meaning of alpha? If alpha is positive, that means what you earn by investing into SJ is bigger than what Pharma French three-factor model says you should earn. So alpha is always about the extra returns. Now, when alpha is not equal to 0, we're gonna say we find return anomaly in terms of Pharma French three-factor model. So there are three famous Pharma French three-factor anomalies. The first one is the momentum, second is the profitability, third one is the investment anomaly. So what is the momentum anomaly? If you invest into a group of past winner, you tend to get the higher holding period returns. Now, this part is important, even after accounting for the Pharma French three-factor risk. So it's not just about getting positive return, it's about getting alpha. So alpha on the winner groups, investing into a group of winning firms, past winners, you're gonna get extra return. How do you implement? You're gonna implement using winner minus loser strategy. You're gonna buy a portfolio of past winners, but you're gonna finance it by selling a portfolio of past losers. So we're gonna use this symbol, winner minus loser on average, right? The average returns on winner minus loser strategy. What about the profitability? So we find that if you invest into a group of past robust profitable firms, you tend to have higher returns even after accounting for the Farr-French three-factor risk. So this is again about the alpha, extra returns. How do we implement? Robust minus weak strategy. So we're gonna buy a portfolio of past robust profitable firms, but you're gonna finance it by short selling past weak profitable firms. So robust minus winner expected return. So we're gonna use this symbol. Investment anomaly. If you invest into a group of firm with low investment last year, you tend to get the higher returns even after accounting for the Farr-French three-factor risk. Again, this is about alpha. And if you can implement this strategy, this anomaly, using CMA strategy. C here means conservative firm with low investment. A means aggressive firms. It means it's group of firm with the high investment last year, very aggressive investment, right? So we want to buy past conservative firms called portfolio C, conservative, but you're going to finance it by short selling aggressive firms, portfolio A. And we're going to use this symbol, conservative minus aggressive, expect return on that using this symbol, right? So we find three important anomaly based on the Farmer-French three-factor model. Previously, we find size and value, and we add that as two factors, right? Now we're gonna do the same thing. We find three anomaly in terms of Farmer-French three-factor model. We're gonna add these anomaly as factors for the next asset pricing model. The first one is the Carhart four-factor model. So alpha in terms of Farr-French three-factor model now become beta, it means factor in a new asset pricing model. So we have excess returns from investing into SHA, average return, is equal to market term, the CAPM term. These two are Farr-French three-factor terms. The last one is the winner minus loser momentum terms. So we call this as the Carhart four-factor model. Now Farr-French add robust minus weak, conservative minus aggressive as a new additional factors. Now you may wonder why Farr-French didn't add winner minus loser as a factor, because Farr-French couldn't find any economic rationale for this guy. We talk about some economic rationale for SMB and HML, and there could be some economic rationale for these two. That's too much, so I don't teach that here, but they didn't find any economic rationale, so they are hesitant to include this one as a factor. So we have Carhart four-factor model, and we have Farr-French five-factor model. So that's the domestic asset pricing model. Now, if you are allowed to invest into international stock market, we should use the more advanced asset pricing model. So the above one is just for domestic case where you can only invest into your own market, domestic market. Now, if you are allowed to invest into international stock market, we have to use different asset pricing model. The starting point is, again, CAPM. Domestic case, we start with the CAPM, right? In international case, we start with the CAPM, but with one important difference. Here, instead of using domestic market portfolio, we're gonna use world market portfolio to include every risk asset in the world. So ideally, world market portfolio should include every risk asset in the world, and the portfolio weight should be following this market value of each asset. Anyway, so we call this as the world CAPM. And excess return investing into SHA is equal to now beta of each asset and the world market portfolio and world market excess return. Now, when can we use this asset pricing model? With fully integrated market, so everyone is free to invest into any risk asset in the world. And we assume there is no premium for taking FX risk. Well, is this realistic? When we use real return and when we assume relative PPP hold, we may be able to use this model. We talk about this one in portfolio diversifications. When this is true, every investor in the world could use this US portfolio diversification example. Anyways, so with this fully integrated market, and if we assume no premium for taking currency risk, then every investor in the world can use world CAPM in dollar term. So they don't have to worry about any currency here. they just use World CAPM in dollar term. Now, what about with the fully segmented market? Then each country's investors, they can just invest into their own domestic market. They cannot invest into foreign stock market, right? In that case, for each currency, they should use each country's domestic CAPM. So for US, they use US CAPM. For UK, they will use UK CAPM. For German investor, they will use, well, German CAPM, right? Which, when I say German CAPM, it means the market portfolio is coming from only German market. So we have three cases actually. Fully integrated case, you're gonna use World CAPM, where you use world market portfolio. Fully segmented market, each country's investor will use each country's domestic CAPM. Now there's also some middle ground. Well, in real practice, Baker Harvey says it's more realistic to assume partial integrations. So some investors, they are hesitant to invest into international market because they are not familiar with foreign culture, foreign policy, whatever. So there could be some psychological barrier, legal restrictions. We talk about this one in the lecture, transaction cost, tax, political risk, FX risk. For whatever reason, even though any investor can invest into foreign stock market, they are hesitant to do that. So because of this, in fact, the fully integrated or fully segmented, both are not that correct statement. So they said we have to think about asset pricing model where only we have partially integrated market. Then they propose this idea. Basically, you're gonna use weighted average. So market access to the left-hand side is same as before. So you average return investing into SHA is in the left-hand side as before. Now first term, so we have two weight, WT1 minus WT. So two weight, this is weight term. And we have world CAPM and domestic CAPM. So what you're gonna use is the weighted average of the world CAPM and domestic CAPM. Now this WT is going to determine this weight. So if WT is equal to 1, that means the markets are fully integrated. So this term becomes 0, and you're gonna use world CAPM. If WT is equal to 0, that means there is no world market term. Each country should use each country's domestic CAPM. If WT is between 0 and 1, like a half, then you're gonna put 0.5 weight to world CAPM and 0.5 weight to domestic CAPM, right? So it's the intuitively clear, I think. And then when we talk about the international asset pricing model, you need to know the difference between these three terms: local portfolio, regional portfolio, global portfolio. Which means, what is the meaning of local portfolio? For example, if you're a UK investor, you're going to use only UK stocks to compute something. It's a local versions. Now, if you're US investors, you can combine US and Canada as a one region, North America region, Canada, and you use US stock and Canada stock to compute portfolio. That's called regional portfolio. You can do that for European Union, Asian country, Latin America, North America, etc. So that's called regional portfolio. What about the global portfolio? You use every risk asset in the world to compute global portfolio. So we have to differentiate local portfolio, regional portfolio, and global portfolio. Now, for example, whenever I put L here, that means local. So local SMB, for example, UK SMB, you only use UK stock to compute SMB in UK. Whenever I put R, that means regional. So R SMB, one example could be Asian SMB. So when you compute small minus big, you use all Asian stock. Whenever I put G, that means global portfolio. So GSMB, one example is going to be MSCI SMB. So this means I use every risk asset international stock listed in MSCI to compute SMB. So you need to know clearly the meaning of local, regional, global. Now, from this point, this is the one I'm going to talk about this Friday, but I can give you intuition on this one. In a fully integrated market, in this week's lectures, I'm going to show that we see size anomaly, value anomaly, momentum anomaly, profitability anomaly, investment anomaly. We talk about this one for domestic case. We find this anomaly in international stock market for each country, for each region, and global portfolio. So we have similar anomaly even in international setting. Now, once you find alpha, that will become beta, right? So if you assume fully integrated market, I told you this is very important intuitions. In a fully integrated market, we're going to use global world CAPM. In a fully segmented market, each country will use domestic or local CAPM. Now, hybrid market, when I say hybrid, which means partially integrated ones, partially integrated world, we're going to use weighted average, right? This intuition is still hold. So let's say fully integrated market. Then based on size, value anomaly, we can think about global power French three-factor model. If we think about momentum, W minus winner, winner minus loser, we can think about global version of Carhart four-factor model. So in a fully integrated market, we have three asset pricing model, power French three-factor, Carhart four-factor, power French five-factor. Now this form is exactly the same as the domestic case, but one thing is different. What is different? When we compute factor, market portfolio, when you compute SMB, HML, winner minus loser, loss bust minus weak, conservative minus aggressive, we use G. What is the meaning of G? We use global stock. So in fully integrated market, we use global portfolio to compute each factor, the global model. What about the fully segmented case? Intuition is same as before. Each country's investor will use each country's power French three-factor, Carhart four-factor, power French five-factor model, right? So fully integrated case, fully segmented case. What about the partially integrated case? We're gonna use hybrid model, which means just we're gonna use weighted average of the world and local. So we have hybrid power French three-factor, hybrid Carhart four-factor, hybrid power French five-factor model. We have many symbols here, but it's not that difficult to know what this means. For example, power French three-factor model. So this is the average excess return you can get by investing into SHA. So left-hand side is always same. Now in the right-hand side, first three terms is a global three-factor. Last three terms is the local three factors, local CAPM. So here L means local market portfolio. LSMB means local SMB. LHML means local HML. So this is just a weighted average of the global and local factors. Now weight is given inside this coefficient. You don't see weight WT clearly here, but you can say that that is behind this coefficient here. What about Carhart four-factor model? It's a weighted average of the global and local factor. Again, the first four factor is the global Carhart four-factor model. You see here, global the Carhart four-factor model. What you see here is the local Carhart four-factor model, just weighted average of this. Power French five-factor model, now you see what we're going to talk about here, right? So we have global power French five-factor, and below you see local power French five-factor. So just weighted average. So it's not that difficult to even memorize this one. If you are able to memorize only five-factor model or and Carhart four-factor model, everything else is just you use either G or L. I think you know what I mean. Anyway, so then finally we're gonna learn about Carroll and Wu model in these Friday sessions. They are still using this Carhart model, four-factor model. So the special thing about this paper is they say when you compute global and local, you have to use the right one. You have to be very careful. So they define something called globally accessible stock. So what is the meaning of global stock? So you use every risk asset in the world. But however, that's not literally true. Some stock, you may not be able to buy them, right? That stock should be accessible. So they define accessibility somehow. We're going to talk about this on this Friday. And then they compute global factor using only globally accessible stock. They use local factor using locally accessible stock. So they just use the same hybrid Carhart full factor model, but they find a new way to get the right global factors and local factors. So that's the one. That's the summary of the topic 5. And given this knowledge, let's talk about practice question on topic 5. There are 2 parts. Part 1, this is just ask you to summarize the key point in the lecture slide. So the first one, explain the concept of the size and value premium as CAPM anomaly. How would investor identify these as alpha in terms of CAPM and implement trading strategy to earn each premium? In the answer, you will find this one. So it's just, you should summarize page 12 to page 20 of topic 5. But I just review the key point on size anomaly and value anomaly, how to implement that, what is the meaning of alpha in this review slide, right? So summary of this review slide can be actually the answer for these questions. Explain the concept and why they are called CAPM anomaly. So you have to show that regression form. You have to show that what is the meaning of alpha and what is the meaning of size anomaly and value anomaly in terms of alpha, right? And how to implement, that's the SMB strategy or HMS strategy. So I already explained this one. And then explain the momentum, profitability, and investment anomaly as a far-flung 3-factor anomaly. In the review slide, I also talk about this one, right? So you can just use that as an answer for these questions. And how would investor identify these as alpha? So you're going to use the regressions. How do we implement? So you're going to use winner minus loser strategy, implement winner minus loser, robust minus weak, conservative minus aggressive, right? So in the page 23 to page 40 of topic 5, or you can use the review slide, the key point in the review slide. Finally, this is the one I'm going to talk about this Friday. The reference to Far-French 2012, Caroli and Wu 2018 carefully evaluate the view that multiple asset pricing model capture size, value, momentum pattern in international average returns. So they're going to talk about global model, partially integrated model, segmented model. In the lecture slide, you will find that Far-French says we shouldn't use hybrid model. Caroli and Wu says we should use hybrid model after computing globally accessible stock, using that to compute global factors, using locally accessible stock to compute local factors. Anyway, so you are supposed to summarize that thing for this question. So based on this one, also based on my review slide. Anyway, see, whenever you try to answer these kind of questions to get good marks, you have to use equations, you have to use regressions, and you have to define everything precisely. What is the meaning of alpha, etc., right? So that's true even for the exam, for the short questions. You have to use equations, regressions, you have to define everything precisely. Now, how do you prepare for the exams? Short questions. One thing you can do is to try to write down the answer for practice question as precisely as you can. And that could be, well, part of that could be copied and pasted as the answer for the actual exam questions. The actual exam question will be based on the lecture slide and will be somehow similar to this part 2 practice question. Now, if you are able to answer the practice questions using regressions and equations very clearly, then your answers for the short question, the actual exam question, will be just a slight extension of that or a slight modification of that, okay? So obviously you have to prepare your answer for this practice question before taking the exam, because you will copy some of that as your answer for that, okay? Okay, part 2, real world application of topic 5. I'm going to provide a sketch of answers. Let's say a quant in your company have developed a new zero cost investment strategy. Zero cost investment strategy means buy a group of firms, but finance it by short selling a group of firms, right? That's the zero cost investment strategy, like SMB, HML, right? Winner minus loser, etc., etc. So quant find new zero cost investment strategy in US stock market based on some innovative use of a historical accounting and stock data with a good story. We don't have to know what is this innovative data use. You can just treat this as the X. Following some criterion X, this guy developed a new strategy. For example, when we first find out size anomaly, what you can do is you rank every stock in terms of size, characteristic. You form 5 portfolio. We talk about this one in the lecture, right? So the biggest firms, smallest firms. If you think investing into small firm is making sense, you're gonna buy this one and you're gonna sell this one, right? So if I call this criterion as X, you're gonna rank every stock in terms of X. You're gonna form 5 portfolio, lowest one, highest one, right? And you're gonna buy one group and just sell the other group. That's so-called zero cost investment strategy. That's how you implement zero cost investment strategy based on some criteria, right? Size, value, right? We talk about size, value, momentum, profitability, investment, right? Let's say if you find X due criterion, you can implement that by sorting portfolio, by buying a group, and by just selling a group, the other group, right? So this guy find a new way, X, and rank and implement zero cost investment strategy. And would like to claim its potential to you. So you are the head of the active investments. So you wanna do active investment. So active investment means you find a group of firm, underpriced one and overpriced one. You're gonna buy underpriced one, and you're gonna sell on the overpriced one, right? You try to find a new criterion. That's so-called active investment strategy. What about passive in the investment strategy? Passive means you're just following, for example, market index. So you don't do any research. You just buy an ETF on market index. So return from that ETF is going to be the same as the return from investing into market, right? So you just follow others' strategy. That's a passive one. Active means you're trying to invent your own strategy. So active investment. And somehow in your mind, you think CART model is a right model. So you're going to use CART model as a right model benchmark. And you want to know whether this new strategy is really generating new alpha. We're trying to get the alpha from this implementing this strategy. So benchmark model will look like this, CART 4-factor model. And how do we know this new strategy is generating alpha? We're gonna run the regressions. So left-hand side, this is the excess return from investing into SHA, investing into this asset. So this is the return from buying group of firm and short selling a group of firms. So we have that excess returns from implementing this zero cost strategy. And we have market excess return, SMB return, HML return, winner minus loser returns. And using regression, we're gonna estimate alpha, beta, S, H winners. And we allow some error every period, but on average, error it should be equal to 0, right? And let's talk about 2 different cases. We talk about similar thing in this lecture, right? But anyway, so case 1, let's say we find alpha is equal to 0. What is the meaning of that? So someone is asking a question, chatting. Alpha is the intercept, right? Alpha is the intercept. Beta is the slope for market excess return. This is slope for SMB, slope for HML, slope for winner minus loser. Okay. Let's say we find intercept is equal to 0. That means there is no extra return for this this should be hedge. This zero cost. It's better to say zero cost strategy. Every return you are getting here, if this is equal to 0, every return you're getting is just the risk premium. Hedge fund, again, the zero cost strategy is just combinations of well-known factor, which is market factor, SMB, HML, winner minus loser. For simplicity, let's say we find beta is 0, S is 0, H is 0, but the W is 5, winner minus loser is 6. And let's say this is 30. Let's say this is 30%, winner is WJ is 5, W minus loser is 6%. What this means is this zero cost investment strategy is exactly the same as the winner minus loser strategy. Coefficient 5 means it's just a leveraged winner minus loser strategy. What is the meaning of leveraged strategy? Whenever winner minus loser increase by 1%, this zero cost investment strategy increase by 5 times 1%, 5% increase. Whenever winner minus loser lose by 1%, this strategy will give you negative 5%. This is something like leveraged the winner minus loser. So this strategy is not new strategy. It's just a winner minus loser strategy. So there's no reason to implement this one. There's no alpha from this one. Now, let's say we find alpha J is equal to 25%. This is not explained by all other factors. Then this zero cost investment strategy is a really new strategy, very successful new strategy. Well, the value anomaly, when some people found out value anomaly, they actually implement value anomaly in the real practice. They made a huge profit over the 30 years, something like that. They find the alpha in terms of CAPM, they implement the strategy based on this alpha, and they made a big money about that. Just like that, many people are trying to find a new alpha, which cannot be explained by well-known factors or well-known risk premium, right? So when they find it, they try to get some money from outside investor, and they want to do some hedge fund. Anyway, so that's the question 1. And I can quickly review what we discussed in the lecture slide. Let's say a hedge fund advertised proudly its success for the last 10 years, average annual 30% returns. Then they charge you big fee. You have to pay 2% of your total investment, 20% of your profit as a fee. Do you really want to invest into this hedge fund? In order to think about that, you have to think about alpha, whether this hedge fund strategy generate alpha or not. If this hedge fund just produce well-known risk premium, there is no reason to invest into this hedge fund. So in the lecture slide, we talk about this one. Somehow you use CART model as a benchmark model. Then how do we know whether this hedge fund strategy generate alpha in terms of CART model? We run the regression just like before, and we estimate alpha, beta, S, H, W. And 2 case, if alpha is equal to 0, that means this hedge fund is generating profit by just combining well-known factor. If the hedge fund providing alpha, let's say 25%, then this hedge fund really has some specialty to find out which stock is underpriced, which stock is overpriced, right? So you maybe want to invest into this hedge fund. Alpha is equal to 0 case, there's no alpha, then it's better to invest into buy an ETF on each factor, right? That's what we discussed. So in the question 1 and this lecture slide things, you have to think about whether you get alpha by investing in a new strategy or to evaluate hedge fund strategy. Only if you find positive alpha, then you will be able to say that the zero cost strategy or hedge fund strategy is really special. Now, the big question here is which benchmark you have to use, right? Why you are going to use CART model here? There's no reason for that. So whenever I ask this kind of question in the actual exam, The rest of the procedure is similar. So you have to run regressions, you have to take expectations, you have to think about alpha, blah, blah, blah. But the most important question is, what is going to be your benchmark? So given the questions, you have to provide some rationale why you pick certain asset pricing model as your benchmark model. And based on that benchmark model, you're going to talk about regressions, you're going to talk about alpha, you're going to talk about how to implement that, right? So that's most important part. Here we are assuming CART model is a good benchmark. But in the actual exam, you have to provide me a reason why certain model is a good model and you're going to use it, right? So for that, this question might be important. Think about what kind of benchmark model you're going to use for these questions. Kim Deal, an equity researcher working at AMBS hedge fund in New York, so New York investor, US investor, has developed a new way of measuring certain things, certain characteristics, earning potential of 100 company in China. And Kim Deal is thinking about investing into a group of company in China. Using historical data, Kim Deal formed 10 portfolio based on EP, just like what we did. So we first compute the, for example, 5 portfolio based on size. Here, he formed 10 portfolio based on earning potential and construct a zero cost portfolio, which means buy a group of firm and short selling a group of firms, right? Ranking based on the EP. And this one means high minus low on based on earning potential. So this actually was what the final exam question I gave like 3 or 4 years ago. Some students, they just found this terminology here, HML, and they interpret this one as the high minus low and value form. But this might not be about the related to value form, but this could be a little bit different from value form. So whenever you see HML, it doesn't necessarily mean it's a value form. It just means high minus low based on earning potential as a characteristic. Anyway, so don't be confused. High minus low could mean many other things. High minus low on size, high minus low on value, right? Anyway, find spectacular dollar average return on HML based on earning potential. And Kim Deal used CAPM, but Kim Deal couldn't justify the excess return from investing into this portfolio, which means this is CAPM alpha. This is CAPM alpha. Explain the reason why such returns on HML EP, high minus low based on earning potential, can be still considered to be a reward for taking systematic risk. This question wants you to think about what is the good benchmark. Even though this is the CAPM alpha, that doesn't necessarily mean this is the alpha for more complex model. Let's say you use Farr-French 3-factor model, or CART 4-factor model, or Farr-French 5-factor model. This could be CAPM alpha, but there could be no zero alpha, there could be zero alpha if you use this model or CART model or Farr-French 5-factor model. That's actually could be the answer for this question. You have to use right benchmark. Maybe CAPM is not a good benchmark. If you use more complex model, perhaps alpha could be 0. If alpha is 0, then you can think return on HMLEP is just reward for taking systematic risk, either taking SMB risk or HML risk or momentum risk, or right? Now there are one more problem with this question actually. Kim Deal is a US investor. She's thinking about investing into China. So right benchmark model shouldn't be domestic model. So previously I just said domestic model. But here, US investor investing to China. So at least you should use either global model or hybrid model. If you use segmented model, that is kind of weird because the segmented model means you are not allowed to invest into foreign country. But here, the question says, Kim Deal is going to invest into China. So the right asset pricing model benchmark should be global or hybrid. Now, which model is the right one? You have to explain why So let's say you think China is fully integrated with the US market, then you're gonna say global factor model should be used. If you think China is partially integrated with the US, then you have to use hybrid model as your benchmark, right? Do you know what I'm trying to say here? When you think about alpha, whether certain strategy generates extra returns, which cannot be explained as a risk premium, you have to use a right benchmark. When you think about right benchmark, you have to use whether you're investing into domestic market or foreign market, right? Depending upon that, your benchmark could be different. And you should provide some justifications on using certain model as benchmark in your answer, right? So that's basically the sketchable answer here. Now, once you determine benchmark, let's say for some reason, you still want to use CART model, domestic model. Obviously, this is not a good benchmark because it is assume segmented market, which is contradictory given these assumptions, this statement. So this is not a good benchmark, but let's say you use this benchmark. Then how do you test whether this is going to be alpha or not? The rest of the procedure is exactly the same as before. You run the regressions, take expectations, the test on the alpha is equal to 0 or not. So rest of the procedure is same. If you just write down like this without justifying your benchmark, you're going to get 25 out of 50. All the rest of the procedure is correct, then you want to get 25. So the most important question here is the thinking about, can you not use a global CART for factor model? So you're gonna say, if you want to use global CART for factor model, you're gonna say why you want to use it. So there are alternatives, like a hybrid CART for factor model, or hybrid even Farfetch 5-factor model, Farfetch 3-factor model. Why you think global CART for factor model is a good model? If you think that is not a good model, you're gonna say China has a well-established financial market, would follow global market. If you think like that, you can write down like that. So the important thing is about providing me a justification. But there's one problem with China. Actually, there's a big capital flow restrictions. So as a foreign investor, if you invest into China stock market, if you make good profit, maybe you cannot repatriate what you earn back to your country. That's a capital flow restrictions. That's a big investment barrier. Because of that, some people may not want to invest in China stock market. So what I'm trying to say is that if you provide a benchmark model with good justifications, you will get good mark. But if you just assume something and just provide these procedures without justifications, your mark will be severely low. Okay. Now everything is based on the relative marking. What I mean by that is if everyone is not doing very good, even they cannot generate regressions, discussion on alpha, then if you just write down like this, you could get 30 something. That's what happened 2 or 3 years ago. Even though I explained everything in the lecture slide and during these online sessions, they couldn't even show me regressions or concept on alpha. So I gave like a 30 something to all students who wrote down this one without justifying benchmark. But that might be the case this year. So my mark will be relative. And my expected average is something around 62 to 63. So my marking will be depending upon how well you do in your exam. So it could be 25, could be 35. If everyone is doing bad, you could get 35, just writing that down like this. Okay. Anyway, I'm going to provide more detailed information about the short questions in the last revision class on December 13th. Anyway, last one. These questions are based on the case by this Northwestern professor, Smart Beta Exchange Trade Fund and Factor Investing. First of all, what is meant by factor or smart beta investing? what is the rationale behind it? Now, we talk about value, first size, value, momentum, profitability, investment anomaly, and there are also other group of alpha I didn't talk about. So these five are most size, value, momentum, profitability, investment anomaly are most important five anomaly, and there are also other anomalies, group of anomalies. Now, smart beta means this was initially alpha, called alpha, and become beta, right? So we can say all five are CAPM alpha. If momentum is alpha in terms of Fafren's three-factor model, we could say momentum is a CAPM alpha too, because CAPM factor is inside Fafren's three-factor model. So we can say all these five anomalies are CAPM alpha. In that sense, smart beta factor investing means you invest directly into this anomaly. You invest into size anomaly, value anomaly, momentum anomaly, profitability anomaly, investment anomaly, or group of other anomaly. We invest into factor itself, so it's called factor. What about smart beta? This becomes now beta, right? Initially it's alpha, but now it's called beta because it is a systematic risk. So when we invest directly into this factor, we can say that as a smart beta investing. This is a marketing term actually. So we put smart to signify it's good, it's beneficial to invest into factor or beta itself. Okay. What is the rationale behind it? Traditionally, people recommend something like you put 20% into bond, 60% into stock. That's called traditional investing, traditional portfolio diversifications. Traditionally, the financial market, they recommend us to invest into certain percent into certain asset class, certain percent into certain asset class. Now, what is the important thing is not the asset class. Its important thing is actually the factor behind that class. So it's not like you invest 20% into stock or 30% into bond. You have to think like you are so you think these five factors are important. So let's say market factor 2. You think these 6 factors are important. Then you directly invest into factor. So you say, I'm going to put 10% into market factor, 10% into size, 10% into value, 10% into momentum. So it's not about investing into a group of different assets. It's more like investing into a group of factors. That's so-called the modern way of factor investing. You directly invest into the important ingredient. You don't invest into the name. You invest into ingredient, the factor behind the name. Okay? Directly invest into them. That's so-called factor investing. That's what people are recommending now, many people. Why smart beta ETF that capture size, value, quality? So quality means profitability, similar. Quality and profitability are similar things. Momentum factors to be a combination of passive and active. Your passive means you passively follow other people's strategy, something like you buy ETF on market index, S&P 500. We used to call this as a passive strategy. You don't do any active research. What about active investing? You're trying to find a new criterion by which you can determine a group of firm is underpriced or a group of firm is overpriced, right? You do active research on which stocks are underpriced or overpriced. And based on that research, you're gonna invest. That's the active investing. Why smart beta ETF is the combination of this thing? Because the smart beta ETF is based on past active research. So past active research generate alpha. Now this become beta. So you want to also earn some profit by investing into this past alpha, now beta, right? So you're not following passively the ETF or market index. You wanna invest certain percent of your wealth into certain factor, certain alpha. So in this sense, you're doing everything passively because you're not inventing new factors. You're following already well-known factors, but you want to vary the portfolio weight to each factors following your preference. So in a sense, it's a combination of passive following the style, active, you determine something there, right? So it's a combination of passive and active investing. That's a smart beta investment. Finally, what is meant by the multi-factor ETF? What is the rationale behind it? Now I said you could invest into factor itself, size, value, momentum, profitability, investment anomaly, also market index, right? And all other things. There could be some volatility-induced fact, the induced ETF, or dividend yield-induced ETF, whatever. There could be other ETF too, other factor ETF. Now, you can decide by yourself, you want to put 10% to here, 20% into here, 30% into here. You can determine this portfolio weight by yourself, following your preference, right? Or an expert combine these factors. Why is it is better to combine these factors? Think about portfolio diversifications. There are some correlations between these factors. For example, it's well known value and momentum has negative correlations. Whenever you mix 2 or 3 assets with, for example, negative correlations, you form a portfolio that could reduce variance, right? Portfolio diversifications, the idea. Now, expert says, I'm going to combine certain group of factors as one asset, one ETF. If you buy this ETF, you're already buying ETF of several factors. Now, these factors are, how do I design it? I design it to minimize portfolio variance. So this could be a new ETF, not just investing into one ETF on factors, combining these factors somehow efficiently. And because of these negative correlations or small correlations, by combining these factors, portfolio of that could be better than investing into each asset or forming a portfolio by yourself. So an expert produce multi-factor ETF and propose this one to investor. Investor think they believe this expert skill, they can buy multi-factor ETF directly. They don't have to worry about how much wealth should be invested into each factor or whatever. Now, there are actually the ETF, multi-factor ETF, actually traded in the market. If you take a look at this one, will show you the multi-factor ETF. So the logic is by doing this portfolio diversification things, you could get the better portfolio. Okay, so this is going to be the end of the topic 5 sessions. Do you have any questions? If you don't have any questions, then we can just stop here. Thank you for your attendance and have a nice rest of the day. So I'm going to stop.